get all the information. I've asked Sharon to lead this thing because it's all about reporting and transparency for not-for-profits in New Zealand, which is really important. And I know Sharon has been involved in this sort of stuff for ages. Um, I know for a fact my own personal journey is that I'm getting absolutely inundated at the moment with um, companies wanting to sell me products that will do this better for me, which will remind me to do stuff and all that. I don't know whether you guys are or not, but that's it's definitely been very, very, very painful. Let's put it that way anyway. But I'm going to keep quiet now. Sharon, the floor's all yours. Hopefully, I'm sharing my screen that everyone can see that.
Yep. Yeah.
Great. So I'm the
Thanks.
person doing all this today, and I'm the, yep, what do you call it? The PowerPoint person. So go for it. Oh, wrong one. There. Go. Shoot.
Awesome. Thanks for being here today. I'm looking forward to chatting through reporting and transparency with you all in the not-for-profit sector, because it is something that sits at the heart of public trust and organizational stability in New Zealand. So it's vitally important that we get these bits right. If you use good reporting, it builds confidence with your members, with your board, with the wider public, with funders, if you are lucky enough to have funders. It is a very, very valuable tool, and it provides amazing information if done correctly. It's not just a compliance cost exercise, which a lot of people do tend to think of things like producing financial statements and audits, etc., is for. So I'm going to cover off why transparency matters in the not-for-profit sector, understanding your obligations and good practice, understanding how reporting can strengthen trust and decision-making is important so that you can build your relationship with your members, your funders, and government if you're getting assistance from them as well. Some really good examples of organizations that use funding, their reporting and transparency really, really well is Women's Refuge and Forest and Bird. They are charities. They publish clear, engaging annual reports that build strong trust with supporters. So go and have a look at them. If you go onto the Charity Services website, you can download these people's reports, or you can get them, generally a lot of places also upload them onto their own websites. So why does transparency matter? What does it mean for a not-for-profit? Transparency isn't just about compliance. It's about trust. And that's the vital point to understand here. It'll strengthen your reputation with your members, the community, your funders, and you don't forget that honest reporting shows integrity. So it means that people, will be able, honest reporting being you reporting the good, but you also report the bad. And I would say that the bad is framed in a very specific way, but it does help build that trust. And members need trust in you. They need to know what you're doing with their funds, whether you're worth belonging to. Funders want to know whether you're worth giving money to. This piece of reporting, especially things like your SSP and that, build this for you. Again, a good example is Kids Can. They use transparent disclosures about how their donations are spent. They actually split it between how much of the donation is going to program delivery and how much is going to administration. So you can see how that helps build strong donor confidence in that instance. So who are we accountable to? Associations in New Zealand operate in a unique trust-based ecosystem. We're accountable to regulators like the Incorporated Societies Register, RD, some of us to funders like the New Zealand's Lotteries Grants Board, and of course our board's members, and ultimately the communities that we serve. Regulators will want compliance. They want those financial statements that meet the reporting standards. Funders will want to know what your outcomes are. Are you worth giving money to? Are you achieving the things that you said you were going to achieve? Boards and members want clarity. Boards use it to assist them with making better decisions. And of course, it also helps to build confidence and trust in your staff. The wider public, well, let's be honest, if anybody has sort of bad press, sort of something bad happens, or you think of some of the sports associations that have hit the media because they've had office staff who have defrauded them, etc. It can be quite damaging to your reputation and cause members to question as to whether or not to belong to you going forward. So again, that wider public perception is quite important. In the New Zealand reporting environment, we have several different bodies that you'll report to. Most of us will be going to the company's office, being the Incorporated Societies register. Some of us will be charities, so you won't have to report annually again to the registrar. You would report via the charity services. And then, of course, we have the External Reporting Board, which determines what reporting standards you have to meet based on the tiered system that we'd all have gone through recently. And then we have funders and grant providers who would also require specific reporting. If you've ever dealt with funders and grant providers, they generally expect you to fill in a certain amount of paperwork once you've completed whatever they've given you the money for. So that will be quite specific, and you would do that per their requirements there. So under the public benefit entity standards, we report a performance report, which the majority of you will have completed, I would think, by now. And the level of detail is determined by the tier that you fit into. Most would be tier 3, but there will be a couple that might be tier 2, probably not tier 1. Small associations will land up in tier 4. You have 6 months from your balance sheet date to have file your annual return with the Incorporated Societies Register, and this is after your AGM, so once your accounts have been approved by your members. If you're a registered charity, you will file directly with Charity Services, and you don't have to do it on the Incorporated Societies Register. The public benefit entity standards, they can get quite complex, and they've come into effect for all incorporated societies under the new Act 2022. A lot of people might have adopted them a bit earlier, but you will, the moment you've re-registered, you have to use them. You haven't got a choice. The idea behind this is that for a very, very long time, charities and incorporated societies had a mismatch of reports. Some people went to the expense of having proper financial statements drawn up, having audits completed or a review completed and uploading that information, and other really volunteer-led associations or organizations simply would have uploaded their bank statements. So as you can see, it's hard to determine what's going on if you're uploading a bank statement, and it also makes it very difficult to compare apples with apples. It makes it difficult to regulate. So that's why they've brought in the reporting standards, that everybody has to meet this. The charities have had to meet these tiers since 2015. So it's quite a long time that they've been doing it, whereas for the rest of us, it's a fairly new thing. And we meet them based on your tiers. So that is determined by how much expenditure you have. They've updated it fairly recently. So tier 1 is if you have public accountability, you land up there immediately, or if you're a large entity, so you have total expenses over 33 million. Tier 2, you have no public accountability, and you have total expenses over 5 million, but less than 33 million. Tier 3, which is where most of us will fall, you have no public accountability, but you have total expenditure less than 5 million. And Tier 4 is no public accountability and total expenses of less than 140,000. If your society has operating expenditures, payments, as well as current assets of less than $50,000 in the last 2 consecutive years, you do not have to meet these standards. That's quite important for the really little, art society or something like that. You don't actually have to report under these tiers if you tick that box. It's also worth noting that if you exceed your total expenditure for the 2 consecutive years, would be the year you're in that you're going to report and the prior year, that then you need to move up a tier in that second year. But if your expenditure drops at any point, you can move down. So if you were in tier 3 and now for whatever reason you have this year have done under $140,000 worth of expenses, you can actually move down and report in the simple format, which is cash. Cash is just literally using your cash book, whereas accrual means that you have to account for things on the earlier of the date that you receive the invoice or payment is received. So that's the difference there. Accrual also requires you to pass journals to account for prepayments, income received in advance, etc. So it's quite important to get this right. If you're not sure, reach out to somebody like myself. I can talk you through it. There's also a lot of information on the Incorporated Societies Act and the Charity Services where it can step you through exactly how to work out what you need to do for which reporting tier you're in. So what do good financial statements show? They tell the story of how money enters your association and how it leaves your association. It also shows how well we look after things like your assets, your people, and what matters to members, being the advocacy or the reason that you exist. It will also answer questions like, are we sustainable? Are we living within our means? And don't forget the stewardship of the funds. They trust us with their money, and our reporting needs to show them what we've done with it and how we are looking after it. It's worth remembering financial statements look at the past. So it's what we have already done. Your board or monthly reporting looks at the future, and that is, I would really encourage you to have sound board reports. You can use them for a lot of different exercises. Obviously, it's what you've done year to date and how you're going to see out the rest of the year. But do note, things like a budget versus actual report can highlight if you have no plan. If your budget doesn't align to what your financial spending is, it really puts a spotlight on the fact that you haven't planned out what you're going to do, unless you've had to pivot. You might have had to pivot. If there's a sound explanation, then you're fine. But if there isn't, it can really highlight that you haven't planned your budget. So it's worth doing that exercise very well as well. The dreaded SSP, or Statement of Service Performance, that a lot of entities have struggled with and do struggle with when it comes to their audits. It's really a good report. It is not a financial report. It is a written comms report. You want somebody who's good at storytelling. It's your opportunity to tell the world what your impact has been for the last 12 months. What have you done? What are the significant, and it's key here, significant things that you've done this year? So financial information alone cannot demonstrate your impact. This is your opportunity to highlight it. I will say this, though, be very careful. When you are audited, they can audit every single line. And here at Rural Women, with our audit last year, they literally, and I'm not joking, audited every single piece of information we had in there. We had to prove everything. So it is worth setting up a filing system for yourself at the beginning of any year. And if you haven't got one yet, set it up now. Save the emails from members that thank you for things. Save links to the articles that you have been mentioned in. Save all your submissions and proof that it was submitted into the folder. anything and everything that you may want to include in your statement of service performance, put it in there. Rather have more information than less. It makes writing the SSP a lot easier because it's all there. But it also, when you audit it, you've got the proof. They want third-party proof that you've done these things, that you met with the minister, that you, whatever it is that you track as your outputs there. Remember, outputs are what we did. Outcomes is what has changed. A lot of funders are wanting to see evidence of change. So what you're actually doing with the money they're giving you. It's quite challenging because impact measurement can be messy, it's long term, and it can be hard to qualify. So, for example, two different people looking at the same evidence might come up with a different conclusion. Some examples of this: Lifeline Aotearoa reports outcomes such as call volumes, wait times, crisis de-escalation. So it's showing real world difference, not just the dollars spent on these services. SPCA is another good example. Output is animals cared for. Outcome is the rehabilitation or rehoming success. So you can see the difference in those. So transparency, I think we might need to move on, Brett. Transparency beyond numbers. It gives governance clarity, funding disclosures, ethical decisions. It means disclosing information in a way that members and the public can understand and interpret where an association is at. So, for example, you need to disclose restricted versus unrestricted funds or reserves. If you think of an entity that has $100,000 in the bank account, but they have restricted funds or a reserve for $100,000, it means the money they've got in the bank account can only be used for that purpose. It means that when you're reading your financial information, your members can go, oh, how are they going to operate if there's no more money in the bank, etc. So it's very important to clearly distinguish whether there's restrictions around things or not. Other potential disclosures that you might need to note are amounts payable or receivable from controlled entities or associates. You would need to disclose if any terms differ from normal arm's length terms. And for a few who are in your higher tiers, they have to disclose the aggregate remuneration of your governing body and senior staff. You could also need to disclose climate-related matters if they are considered material. So, for example, I don't know if you guys were involved in preparing financial statements, but around COVID, you had to put in a note to disclose whether or not it had impacted you and whether you would, there was anything that any reader of the financial statements needed to be aware of regarding the fact that there was the whole COVID period and the impacts of being restricted tradings and stuff like that. So it's those sort of notes that fundamentally a disclosure note that you need to put in here is when it's going to impact somebody's interpretation of your financial situation or your financial statements. If they don't know that information, does it read differently? Another one is that a lot of people will have seen in their financials is if anything material has happened post year end. Now, a lot of people are sort of like, oh, well, you don't have to tell people about that, but there are audit checks that will pick it up if you haven't disclosed it. Things start to come through that when they're just doing their normal testing, that they'll start to pick up and look and scratch around in if you don't disclose those sort of bits and pieces. Another one that is quite common in the not-for-profit sector is our conflicts of interest or related party transactions. So they're common, they're not bad, but failing to disclose them is a big issue. Related party transactions is a note that you pop in with your financial statements that will determine if there's a risk of funds or services being impacted due to a relationship that has undue influence. So a good example of that would be if you have board members who are also, say, have their own consulting business, you engage the consultancy business to do certain work for you. They're obviously being paid for this work. It indicates that would you have that consultancy piece of work being done at the rate you have if it wasn't for the fact that they were a board member. Another good example would be that you would have a board member who is also in the C-suite or senior management for, so one of your big sponsors. And would you actually get the sponsorship income if they weren't sitting on your board? That's why you disclose related party transactions. It's always worth a read if there is that note in the financial statements, because it can actually indicate that there could be a problem, and it might just be a disclosure requirement. There might not be any risk whatsoever. Other disclosures that boards should make and would be a conflict of interest, and that is, for example, if they are recruiting for a senior role and they have a prior working relationship, or it's a family member or something like that, that they are not what we term a third party relationship, which is an arm's length relationship. For example, if you were going through a recruiter and you just had 10 people to interview that you'd never met in your life, that's a third party sort of relationship. Whereas if there is something that could be a conflict, it needs to be declared, and those should be recorded in your board minutes. You should also have an interest register. Do maintain that. It helps you with being able to prepare these notes in your financial statements, but it also helps you protect your association from, again, that wider public perception if you get this all wrong. So the Incorporated Societies Act 2022 has lifted governance expectations. You're required, as most of you will know, now have a governing body or committee that runs it. It has to consist of at least 3 people, and each of those people are officers of the society. You'll have gone through the exercise probably of getting a new constitution, and that will contain the clauses of exactly how your board committee runs, what positions you have to have, how you elect them, how they are removed, what functions and powers they have. But the Act is now also setting out clear officer duties, reporting, conflict management, re-registration requirements. It's placing stronger emphasis on governance maturity. And this is going to be one that I think all volunteer boards will struggle a little bit with, because people often use volunteer boards to sort of cut their teeth and learn about governance. It does require an officer to act in good faith and in the best interests of the society, exercise their powers for proper purpose only, comply with the Act and the society's constitution, exercise reasonable care and diligence, not create a substantial risk of serious loss to creditors, and not incur an obligation the officer doesn't reasonably believe the society can perform. Now, that is quite important, because if the officer breaches their responsibilities, they can be held personally liable. That includes fines up to $200,000 or imprisonment of 5 years. So make sure your board understands that, and that they have people with the right skill sets to manage that, because personally liable, they go after you in your personal capacity. It's to prevent people from just doing as they like and sort of hiding behind the "I didn't know" aspect of things. The Act also now requires audits and reviews, depending on your size. So if you're not a charity, and in each of the 2 preceding accounting periods, the society's total expenses is more than $3 million, you will need to be audited. So you don't have a choice at that point. That is what the Act says. Your constitution may or may not require you to be audited or reviewed if you're under that threshold. Some funders, so if you're getting public funds, etc., will require you to be audited regardless of your size in order to be able to qualify for the grant or funds. A lot of people think of an audit as really a compliance cost, but it can be a really valuable tool for strengthening your organization. It is a set of independent eyes that will, through a selection of a pool of transactions, determine whether you have materially misstated anything. But in that process, they also check your controls that you have in place. They should highlight if there are any weak controls or if there's anything that is concerning to them or that you could do better. That will be put into your management report, which will go to your board. But they should also be highlighting if there are key changes coming. So reporting changes and things like that. If they aren't doing this for you, if you're not getting that additional value from the exercise of people auditing you, it might be worth going out for a request for proposal for an audit services. You might be quite surprised. There are quite a lot of sort of fairly proactive auditors. They can't give you financial advice, but they definitely can highlight how you can strengthen your internal control environment or good practice. Under the Charities Act 2025, a charity has to be audited if the expenses exceed $1.1 million in each of the 2 previous financial years. If you have expenses that total more than $550,000, then an audit or review is required if you are a registered charity. So they're quite different depending on whether you're a charity or an association, and just reporting against the Incorporated Societies Act. You can be both, in which case then the charity services requirements kick in. One of the big benefits is that audits, as I say, bring a good set of independent eyes and give reassurance to your members that you are actually following the correct processes and policies that you've set up. So whereas a review is a far lighter touch and you just have somebody who goes through the things, but it isn't as vigorous a process. So internal controls, what are they? They are how you do things. So your workflow for approvals, segregation of duties, so you don't have the same person doing absolutely everything. And I know in some associations, this is not the case. It's your oversight by the board would also be another control that's in place. If you're one person and you're doing it all, there's no way to get segregation of duties, but you do a good protection in place is that, for example, a board member would sign it off and authorize the payments at the bank, or 2 board members if you've got several. Internal controls really are designed to protect the people who work there as well as the organization. Remember that it goes in a sort of one-up. You've got a staff member who would authorize their stuff, a manager who would authorize the manager's stuff, the CE who would authorize the CE stuff, the president or your board chair. The board chair stuff, the board as a whole. And make sure you have evidence of this so that you can use software like Approval Max to do all these approvals and things like that, but it does cost money. You can also have it signed digitally or like literally, not ideal, but print it out and sign pieces of paper. You need basic internal controls no matter what size you are. The more complex you are, the more staff you have, the more complicated your control environment becomes. It is a cost versus benefit exercise though, as I say, and just practicality. If you're one person running an entire office or an association, obviously you cannot segregate duties and have different people sign off different things. You can consider bringing in, for example, somebody who's got some expertise in areas like for GST returns and things like that you have an accountant prepare them for you. That would give you that level of segregation that your auditors will look for. Remember, it protects the people and it reduces the risk of fraud. It also protects the organization. If things go wrong, because they do go wrong, people do commit fraud, sadly, it should help you detect it quicker if you've got good internal controls. Again, I'll bring up that if you think back to last year and that there were a couple of rugby clubs that got defrauded of a lot of money because one person controlled the receipting and the banking. If they'd had a bit of a segregation of duties, some checks in place by a different person, it might not have prevented it from happening, but it sure would have meant that they probably picked it up quicker and sooner, and therefore the monetary value of it would have been less. Sadly, people often use opportunities. It's not always intended as a bad, people aren't necessarily sort of out to just defraud things. For example, if you're working in a sort of hospitality environment, good controls over your till and the cash are really, really vital, because staff quickly pick up if you have no idea how much money is sitting in there. And it can start out by being somebody who needs to cover their rent or buy some groceries, and they take the money, they put it back, nobody notices, and that's how it can escalate. And that's why I say good controls, good checks are vital. You can use your reports for better decisions, and this is what your board really, really needs. Your statement of service, your performance report, your financial statements, that's a year-end report, that's a compliance requirement, that's reporting to your members what you did for the year. But as I say, that can be sort of 18 months post when something happened. If you use reporting regularly to your board, it makes for better decisions for them. You can use reports like the budget versus actual analysis. This is where you're at. Those same reports can then inform your forecasting, which means you're going to take out and go, well, this is where I'm at. This is where I think I'll be at year end. And it will also help your planning. They don't have to just be, a lot of people find a financial report very overwhelming and they don't know how to read them, and you need to read them in conjunction with each other. You can also put in, and I would recommend, a bit of a written summary of it. And within that, some people do find it quite helpful to have some graphs, because a picture is worth 1,000 words and people understand it better than it just written. The likes of Habitat for Humanity uses dashboards that links their finances to how many homes have been built, the repairs that have been completed, volunteer hours that have been given. So you can use them in very different ways. But as I say, link your financials to your strategy. It also helps improve your governance, and it means that you're making sound business decisions with accurate, timely information, which is vital. If you're only making decisions 18 months post an event, you may not be around as an association anymore to be able to deal with the situation. So some of my practical tips to improve your transparency: small steps make a big difference. If you can, adopt templates, plan out your reporting cycles early, lock in your audits early, lock in, if you have advisors that help you with this, to prepare them, lock them in early, set your time frames so that they know well in advance when things are happening. To give you an idea, I always lock my auditors in the day after my AGM. They've been reappointed or appointed. I lock in my timetables with them, and they know exactly when they will be on site. I know exactly when they're coming for interim audits, and we work from there. If you can, it is well worth investing in building capacity and doing training, but I know that that might not be a reality for everybody. If you can't, if you haven't got the funds for that, there are a lot of resources available. There's this team with NZA, and reach out to Brett. He can put you in contact with somebody like myself or other member organizations that would be able to answer any queries you've got. There's also the likes of the community governance, which provides good resources, Board Pro, which has good free webinars for governance. If you have a Xero or MYB subscription, etc., they have a vast range of resources online, and you can attend their webinars and do online training there as well. I know with Xero, you could consider becoming certified. If that helps you, it means you can actually use the product really, really well. Corporated Societies Act, Corporated Societies website and Charity Services website and the XRB website have a lot of plain English useful information to assist you there. You can also, all of those resources where big charities have uploaded their financial reports or for year-end and things like that, you can download them off either of the registers, and you can use the wording in there if you're a bit stuck or you don't know how to disclose something. It's another good place to start. I would definitely say get some reports built for you if you can, in Xero for your reporting or MYOB for your reporting, and keep them in line with your performance report. There's nothing worse for board members who are not particularly up to speed with financial reporting to find it hard to go from one set of reports for board reporting right throughout the year, and all of a sudden their financial statements look very different at year end. Try and make sure that they sort of marry up right through the year. You're comparing apples with apples. So transparency builds trust. Reporting strengthens decisions. Done well, compliance adds value. Has anybody got any questions?